Ladies and gentlemen, good day and welcome to the conference call for analysts and investors for post-result discussion for quarter 4 financial year 2022 Arvind Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Agarwal from Arvind Limited. Thank you, and over to you, sir.
Hi, thank you very much, and a very good afternoon to all of you. And thanks for participating in this call to discuss the fourth quarter and full year FY21-22 results of Arvind Limited. Joining me today is Mr. Jayesh Shah, our Executive Director and Group CFO, Mr. Swayam Saurabh, who is our new Chief Financial Officer at Arvind Limited, as well as Mr. Kaushal Shah, who is our Head of Investor Relations. As many of you may be aware, Swayam has assumed charge as the CFO of Arvind recently. Swayam brings stellar credentials and a rich background of leading finance function at large corporates like Ola, Hindustan Zinc, and Philips APAC prior to joining Arvind. Coming to the performance update, FY22 started off on a concerning note as the Delta variant of COVID had crippled large parts of Indian economy and showed weak Q1 results for most parts of the system. Gradually, the momentum picked up, and Q3 and Q4 were some of the best quarters we had delivered post the demerger of Arvind Fashions and Anup Engineering. Through this financial year, we maintained a tight management of operations, working capital, and capital expenditures. This prudent approach enabled the company to continue reducing its long-term debt as planned and shared with you all earlier. Our fourth quarter results were good, in line with the guidance we had provided in January. Q4 revenues stood at rupees 2,204 crores, 2204 crores, which was 33% higher than the last year's number, and quite similar to rupees 2276 crores, which was there in the third quarter. EBITDA for Q4 stood at rupees 235 crores, once again very similar to rupees 237 crores for Q3. In terms of the year-on-year comparison, the Q4 EBITDA for the last year, FY21, was rupees 208 crores. For the full year, the overall revenue of the company increased by 58% in FY22 and stood at rupees 8,034 crores, 8034 crores. Textile revenues grew by 65% and advanced materials grew by 51%. EBITDA for FY22 was rupees 788 crores compared to rupees 463 crores last year. And in terms of margin, the EBITDA margin this year was 9.8% vis-a-vis 9.1% last year. Consolidated profit before tax stood at rupees 5 crores in FY21. That number zoomed to rupees 390 crores in FY22. PAT reported at rupees 238 crores for this year compared to negative 17 crores last year. Now coming to some business-specific commentary, the textile business volumes, especially in export markets, remained quite robust through the year. Domestic market also recovered from second quarter onwards and remained strong through the festival season and rest of the year. In all, denim sold 92 million meters of fabrics during the year compared to 62 million meters last year and 80 million in the year before last year in FY20. So went from 80 to 62 to 92 this year. Similarly, woven volumes also recovered from 81 million in FY21 to 120 million meters in FY22. So in terms of revenues, textile revenues were up 65% to rupees 6611 crores for this year. As you are all aware, the key challenge in this segment, like many other businesses, has been the continuously rising prices of all the input raw materials, most prominently cotton, which continued to climb even though the new harvest coming in the market around November boost down the prices. That did not happen this year. As we close the financial year, the cotton prices closed at all-time highs, and as you all are aware, they continue to do so even post the end of March. Thus far, our key customers have granted us the price increases that help offset the cost increases. Between FY21 and 22, the average realization of denim increased from rupees 191 per meter to rupees 223 per meter, while that for wovens increased from 149 to 182 per meter. While these increased realizations enabled us to preserve the absolute profit in terms of rupees per meter, it did imply a lower percentage margin because of the base being larger. Garment manufacturing operations increased their output through the year as facilities opened post the Delta variant closures. Full garment output for the year stood at 36 million pieces as compared to 32 million pieces last year. During the year, we completed restructuring of some of our facilities across India and also started to gradually ramp down Ethiopia. As you recall, we had shared that the AGOA treaty has been kind of cancelled for now, and hence the duty-free exports from Ethiopia to US have been halted. As such, the attractiveness of that location has come down. So we have started kind of reducing the footprint there. So net our installed capacity has now come down to about 50 million pieces or so, and our Q4 run rate was 11 million pieces, which is about 90% of the current installed capacity. FY22 was a milestone year for our AMD business, which we have talked about in the past as well. This business crossed the 1,000 crore rupees mark, and the revenues for this year stood at 1024 rupees, which was higher by 51% over the last year. The business saw continuing demand for its products as the key global customers granted larger wallet share for the proven products and cost-effective solutions. Like other businesses, AMD also faced cost pressure on the input cost side as the key raw materials such as specialty fibers and yarns, glass tubing, specialty chemicals, and a variety of resin systems, all their pricing soared. Further, majority of this business being exports oriented, the ever-increasing container shipping costs, availability and delays pose severe challenges for these businesses. EBITDA for AMD increased from 98 crores to rupees 128 crores. Although again, for similar reasons I explained earlier, the margin reduced from 14.3% to 13%. We closed the year at a net debt of rupees 1682 crores as of March 31st, 2022. This was lower by 42 crores as compared to December number and lower by 268 crores compared to March 21. So this is the overall net debt, which was 1950 crores at the end of March 21. We closed this year at 1682, which was less by 268 crores. Now, if we only talk about the long-term debt, that number reduced from 1371 to 957 crores. So that saw a reduction of 415 crores. Now, external factors such as the current commodity super cycle, unprecedented inflation in the key Western markets of US, UK, Europe, rise in the interest rate, and the ongoing geopolitical conflicts like war, they bring uncertainty in the business environment and make it very hard to create a full year forecast. We have a good order book for now for this quarter. However, we feel that the EBITDA and the margin percentages will continue to remain impacted because of the steep increase in the input costs, which have been witnessed in the last 3-4 months, and they continue to impact us, in many cases with a lag. However, we stay optimistic about the medium to the long-term prospects of our business. As such, we intend to resume making some calibrated investments in the specific parts of the portfolio. So during FY23, we have penciled rupees 200 crores towards capacity augmentation in our advanced materials and garmenting businesses, as well as certain cost optimization projects for the fabric business as well. These investments also include a solar wind hybrid power project, which will take up our share of renewable power to more than 25% of the total requirements. This concludes my opening remarks. Thank you for listening patiently, and I now invite you to all ask questions. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Sudhir Veda from Right Time Consultancy. Please go ahead.
Yeah, good afternoon, sir, and congratulations for a good set of numbers in last 2 quarters and healthy cash flow as well.
Thank you.
Hello. Sir, my quick question. As I understand that we are mainly now focusing on the capacity expansion in our high margin business and non-commoditized business like AMD and garments. So what kind of volume growth do you foresee in these two divisions?
So this is Swam here. As we have said this earlier as well, both businesses should see year-on-year growth 20% or so over next 1 to 3 years.
Mm-hmm. Great. And textile I think you are not expanding, so can we expect some 5-6% growth, or how it will?
So overall, at company level, we are hoping to grow at about 8 to 10%. So obviously, textile will be lower.
8 to 10% in textile.
No, total company level, Arvind Limited.
Achha. Overall volume growth. Okay, great. And sir, there is one debit item of 125 crore like project expenses. Can you give color to that?
Yeah, so the project expenses, as you know, we have spoken in the past about land monetization. And these expenses, largely about 75 crore out of this number, relates to essentially expenditure done to develop the land. And we have engaged a developer who is actually doing it for us. We have received about 80 crores against this expenditure. It's just that once the site is ready, the revenue as well as the advance will get recognized. The remaining relates to our water business, which is normal project expenditure.
So this year, what land revenue you expect in FY23?
So we have, I think this question was asked in last quarter as well. We expect to monetize about 125 to 150 crores of land every year, and that's what we are aiming to do next year.
Great. And sir, last question. Like AMD division has seen a steep margin decline Q-on-Q basis. So any reason, or this decline will be halted in Q1?
Right. So the decline is, as you know, AMD business also has going through significant jump in all the input, raw material which we use, whether it's glass roving or specialty fibers. So this decline is primarily on account of increased prices. I mean, just to use a reference, glass roving prices have doubled over last 1 year. But large part of this cost increase has been passed to customer, but there is always a lag effect. This is reflected in 12.5% margin which you see for AMD.
So Q1 we can see better margin, right?
I don't think the commodity cycle has subsided yet, but when it does, we should see margins getting normalized.
Great. Thank you, sir. Thank you for the and all the best.
Thank you. The next question is from the line of Nihal Jha from Edelweiss. Please go ahead.
Yes, sir. Thank you so much and congratulations for the strong performance. So a couple of questions from my side. The first is in terms of how we've been able to maintain our margins, it is definitely quite contrary to what we've traditionally seen with some of the other players. So is it the nature of our contracts which maybe are short-term based, or is it that we are clear that maintaining margins is something that we want to prioritize? And generally, are we ready to look at a situation where even if there is some loss of volumes, we are ready to take that to maintain these margins going forward in case the inflationary environment doesn't end up subsiding?
No, so indeed, that's a very good question. The choice, the way we see it, it's crucial to continue to sort of do business which is profitable. What we have done, if you look at also quarter four, some volumes have declined, and that's by choice, where we are taking the tail out, non-strategic tactical sales, which are on lower for our textile business. We are sort of moving away. It's not permanent, but it's a tactical choice we have made at this moment, and we will continue to be choiceful even in coming quarters till cotton and other input prices subside or comes to a normal level.
Understood. That is clear. The other question was on the project expenses part. You did highlight that 70 crores was related to development of land. So it's right to assume that this is more a one-off, and in the coming years, the traditional run rate of say 30-40 crores on an annual basis is what this line item would be, right?
No, it's not a one-off because you would have heard we are talking about approximately 400 to 500 crores of land which will get sold. This is sitting in the closing inventory, and in future also the mode of disposal could still be via development. In that case, this would still, but the key point here is this will help us essentially monetize the land which we have been talking about.
That's it. Just one last question from my side, and I'll come back to you. For the garmenting business, current.
Sir, we're not able to hear you clearly, Mr. Jha.
I'm so sorry. Is it audible now?
Much better. Thank you.
Yeah. For the garmenting business, how is the nature of the contracts that we have with customers? That do we have a certain contracted quantity that we are supplying on a certain price, or is it that it is more on a batch basis where we supply and post that there is a repricing which happens? I'm just trying to gauge the margin salience of this category as it goes.
It's a mix of both. So there are some strategic accounts, but even there we don't have a price lockup for a very long period. But we also have not exactly batch form, but essentially deals-based revenue which gets produced. So it's a mix of both.
Possible to share the ballpark mix of what it is like between these type of contracts?
Yeah, large part would be strategic.
Sure. That will be from my side. Thank you so much.
Thank you. The next question is on the line of Prerna Jhunjhunwala from Elara Capital. Please go ahead.
Congratulations, sir, on good set of numbers. I wanted to understand your capex spend this year, which is reflected in cash flow for 270 crores, where all we have spent, and what is the capex outline for the next 2 years?
Right. So the capex spent for the year is about 185 crores. That's the capex spent in FY22. We have earlier guided 250 crores. Guidance would hold for now, but I think we are trying to be a little bit more conservative given there is far more uncertainty going into future quarters. So there is this whole inflation effect, commodity super cycle where prices are actually not even trying to come down, and that could affect demand, and hence we are more cautious on where to spend, and there would also be some capital reallocation here where this cash which we are going to spend would go into businesses like garment and AMD, which are going to give us faster return and basically better than hurdle IRR.
Okay, so the 200 crores, can you give us a breakup between AMD and garment?
That we have not decided yet, and it will not be entirely on these two businesses. There will also be maintenance capex. We are also going to be investing about 25-30 crore on, for example, hybrid power, which will significantly reduce the total cost of power for the organization. And that also is included here. So it will be a mix of growth investment as well as investments which helps our cost cool down.
Okay. And my next question is on PLI scheme. Could you divulge some details on where the PLI scheme application has been made and which areas you would be expanding into?
Right. So, the PLI scheme and the participants who are approved are announced, and we are one of them. At this moment, as I said, PLI scheme allows you to invest for next 2 years up to FY24. Right now, we are sort of making choices on how much of this investment which we are looking to do next year need to go in garment. Part of AMD will be PLI, but also, the final plan or construct around exactly how much will go into PLI is still being made.
Okay, sure, sir. I'll come back in the question queue. Thank you so much.
Thank you. The next question is from the line of Sagar Parekh from Sagar Financial. Please go ahead.
Good evening, everyone, and thanks for taking my question. My first question would be on the pricing environment. So, you have mentioned the demand outlook on Q1, some issue on the demand because of higher cotton prices. So, just wanted to understand till what level have we, of what level of cotton prices have we already taken the price increases, and how much could be the impact on the margins in Q1?
Arvind, you want to take this?
Well, this is a kind of a continuously rolling sort of exercise which we do, right? We make calls on the pricing for the programs which we are confirming, and we promptly cover up the raw materials. That's how we've been operating for last 2 quarters. It has held us well. Now, how far the market will absorb the price and where things will change is for all of us to really see. But beyond that, at this point, we don't have any specific commentary on pricing and realization in the near quarters and beyond.
So, Q4 would be cotton prices would be about 77,000 per candy, and right now it's about 1 lakh. So, fair to say that entire increase in the cotton prices is still yet to be reflected on the price increases yet in Q1, so that entire effect could come in the margins?
Yes. So,
we hold certain amount of inventory, and that call also is a fairly dynamic call based on where we see the market sort of heading in short term and medium term. Quite obviously, given the pricing levels of cotton which are at near historic highs, nobody, including ourselves, is taking a very long term position on this kind of inventory, right? So, and then we all obviously what we do is there's a pricing side, and then we keep doing our standard approaches towards re-engineering the product, improving efficiencies, and so on. So there are a variety of tools at disposal to manage the situation. All I'm saying is that we are not going to take a long-term call.
Okay. And you think this demand issue which has come up recently, that could subside once let's say the war is over, or maybe cotton prices come down, and what could be the reason for cotton prices to come down? I mean, Xinjiang region is still banned by US, so that approximately accounts for about 20% of global cotton prices, cotton supplies. So what can drive the cotton prices lower going forward? Will it just be the demand destruction that could drive the cotton prices?
So there are 2-3 large factors. One, the new crop of cotton in India would start to come from October. And we will have to wait and see how monsoon goes. But typically that is the time, new cotton comes in, and that equation change also sort of brings the price lower. We are going through in India a very exceptional phase where certain type of cotton, perhaps 2 months from now, availability could also be a question mark. So that's a pretty unique India situation. The fact that import duty has been taken out has also not helped because of this disparity. Now, coming to your question on demand.
Yeah.
The real issue here is if there is, given the inflation where it is, the Fed actions around interest rate, to contain inflation, we will have to wait and see, because in the end, garment, for a consumer, there is a statistics which says 60% of garment comes out of disposable income. So how would that affect the demand at these cotton prices? is something we will yet to see. So far, we are comfortable, next 2-3 months, as it was stated in the opening commentary. But we will have to just wait and watch. And it's a little bit of cat and mouse, because if demand starts to soften, there are other factors which will bring cotton prices down, as it is not necessarily entirely supply. So it's a little bit of uncertain situation to be in. But we also think that, since we are an India-based manufacturer, and globally there is this whole movement around China plus one, I think structurally from a medium-term perspective, it should benefit company like us. And the other point here is the domestic Indian market so far has been very positive. So it's a combination of all of this, and which we think so far Q1, looks to be in control, but the rest of the quarters is just uncertain. We have to just wait how it unfolds.
Sure, and you have given the guidance of 8 to 10% growth. That was for FY23, and that is for revenue growth number, right?
That's right.
Okay, so this is in spite of all this uncertainty prevailing in the global markets, you still feel 8 to 10% growth is doable?
This is what we are aiming for, and we talked about also growth primarily coming from AMD and also from garment.
Yeah.
But this is as far as we can see. We think it's possible. But you also completely understand, other than the war, the whole inflation, in fact, part of the world facing inflation, part of the world going into deflation, could create a very different scenario, and we are just cautious of that. So, goal is to grow entire company next 3 to 4 years at 8 to 10%, with some businesses like AMD and garmenting growing faster. But we'll have to sail through next few quarters. This is all we can say right now.
Okay, understood. And on this gross margins for Q4, if I compare it with Q3, there has been improvement. So that I am assuming would be because of the inventory gains, right? Or how should we look at it? Because just the gross margin without the project expenses, it's coming up to, the raw material cost is coming up to 47.4% versus 54.6%. So there's a substantial improvement. Would that be the inventory gains, and that would reverse in Q1?
3 reasons for it. One is indeed there's sort of a lag effect. Some of the new pricing which gets kicked in. It's also business mix. So, I think high EBITDA businesses like AMD has, as well as garment, has done better. And the third is, of course, part of it is an inventory gain, which should continue till cotton prices starts to come down.
Okay, so it will reverse in Q1 is my question, right? Because then
no, it will not, because inventory, your closing inventory reflects the value of raw material which you have purchased. It might in future when cotton starts to soften, but we might also see a small tailwind coming our way when that happens.
Okay, then technically the margin should not go down in Q1 if the gross margins remain or slightly improve also from Q4 levels. Then just trying to understand how will the margins come down?
Yeah, so I think the point which I made earlier, the uncertainty around volume. So we can see a large part of Q1 already sitting into mid of Q1, but there is still part of the volume in June which requires coverage. That could be a factor. Otherwise, we should be doing reasonably all right on margins in Q1.
Okay, and last question on this 250 crore, there was a provision in the standalone numbers. So that would be, as Samir explained in the opening remarks, could that be the Ethiopia subsidiary that we have provided for?
Ethiopia subsidiary is a large component of that, and there are some other sort of assessment done in terms of negative net worth subsidiaries for different reasons, and it is sort of a one-time cleanup.
That is a cash loss or just a provision?
Just a provision.
And any cash losses possible from Ethiopia or any other subsidiary? We are completely winding down Ethiopia?
No, we are not. We are moving some capacities out of Ethiopia back to India. We might lose about 5-7 million of garmenting capacity in that process, which will build gradually back in India, but we are not completely winding down.
Okay, so are we expecting any cash losses to incur from Ethiopia going forward?
Zero. Actually, it could actually be profit.
Okay. And any other subsidiaries overseas where there was this 250 crore impact, any cash losses to be impacted going forward, or is just...
No, they won't be, but I think if you understand this, these losses or this impact is already in console books because subsidiaries roll up. So this cleanup was done in standalone books only.
Okay, perfect.
And also, it's tax efficient because this is a tax deductible expense.
So what would be the tax rate for FY23? What should we take the tax rate as?
So we are going to move to new regime, and that would mean we'll have an ETR of about 25%.
Got it. Okay, that's it from my side, and wish you all the best. Thanks.
Thank you.
Thank you. The next question is on the line of UP Jain from Canara HSBC. Please go ahead.
Thanks a lot, sir. This is Kirti here. So my question is first with regard to inventory, sir. Last year, we had an inventory of 1160 crores. This time we are having almost double the inventory. So is it a strategic call we have taken, or is it because of the Bangladesh effect the inventory got piled up?
So, see, inventory reasons it has gone up. One is the value. If you look at last year to this year, same volume of cotton would be valued 1.8x. So that's one reason. And other is indeed, on WIP as well as partly raw material, we are sitting on slightly higher inventory than last year, but it's largely value impact.
Okay. Sir, when we see the raw material, we are almost at 6 months of our consumption, sir. So we should sail through the inflationary pressure, right, sir, broadly?
No, I don't think we have 6 months of consumption.
No, sir. Like this quarter consumption is 1100 crores. We are sitting at 2,200 in our balance sheet inventory.
No, that's okay. So maybe we could clarify this offline. As we have explained earlier, we are following, especially for cotton, a coverage of order, and basically we have about 2.5 months of inventory, cotton inventory sitting.
Sir, debt reduction, any guidance for FY23 end?
Right. So as you would have noticed, we have refrained from giving a guidance for next year. But our internal goal is the cash which we accrue would first go into repaying long-term debt, because in our total debt mix, that's the most expensive, and the goal has been to come out of it. Internally we are targeting anything between 300 crores plus minus. That's what we are looking to at least take out.
Sir, last one question from my side. With regard to receivables, our receivable days, we have brought it at 45 days for the quarter, if you see. So we will be able to sustain at this 45 days level of receivables?
Right. I think if you look at historically, it has been around that level, plus minus 10-15%. And the goal is, one of the ways we will optimize going into this year is working capital. So we expect receivables to be around these levels.
Sir, just one more. Sir, with regard to our last slide, we have mentioned marginal reduction in EBITDA. You mean absolute EBITDA or EBITDA percentage, sir?
Absolute EBITDA.
Okay. So, sir, thanks a lot.
Thank you. The next question is from the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Please go ahead.
Yeah, thanks for giving me the opportunity and congrats for good set of numbers. So my question is on the garment facility augmentation. So as you said that currently the garment capacity has reduced to 50 million pieces, and you are right now operating at 90% capacity utilization. So with planned augmentation, where do you see this capacity to go up, and when can we expect this augmented capacity to operate?
Right. So, as we shared with you, we improved our output of full garments from 32 million to 36 million in the FY22, right? For the next year, which is the FY23, the plan is to reach a level of about 45 million pieces plus minus, right? Now, as and when the year rolls ahead, we'll kind of, like you said, we'll put in some investment, and as things play out, we'll come back and share with you specific numbers on what more and where we'll add more capacities.
Okay. So there are no planned augmentation as such that you are planning to set up a new facility. It will be expansion in your existing capacity. Is it the right understanding?
Yes.
Okay. In future, as you have correctly said that medium-term outlook for India as a textile is quite good. So considering that, are there any plans to expand capacities, like setting up the new facilities for your textile business, both for garment and fabric?
See, for now, we have taken a call of continuing expansion through a combination of methods, which includes debottlenecking, which create capacity expansion in the current footprint. We also have used asset-light methods of, outsourcing parts of the value chain. Now, like we said, the overall macro environment at this point is very uncertain to create a commitment to this forum right now. But yes, I think all options are there on the table to, expand capacities as and when the opportunity kind of unfolds.
Right, sir. Right. Thanks for the understanding and all the best for your future.
Thank you. The next question is from the line of Abhay Lodha from Sanmati. Please go ahead.
Hello. Am I audible, sir?
Yes, Abhay.
Sir, my question is related to garment again. Actually, all other garment manufacturing like Gokuldas and Manswara, they are expanding their capacity to the new locations. Then another thing that the government of India is going to sign this free trade agreement with EU and Australia. So why the company is not taking any steps to augment the garment capacity?
So, we are not implying that we are not building garmenting capacity. I think what we implied is there will be a temporary capacity loss because of Ethiopia movement. We said in the beginning also around CAPEX that part of the CAPEX investment is going to go to AMD and garments. And also, if you recall, we said we expect garment as a business to grow at 20%, near about plus minus to 3%. What we are implying is we may not decide to put our own capital in setting up factories, and that's what Sameer was meaning. There are other smarter ways, including outsourcing part of the value chain, and we have already, proven that this works well for us. So we are committed to garment volume capacity expansion. It will be done in different ways and in a capital efficient way is what we are looking to do.
Okay. My second question is related to advanced materials, sir. The advanced material sales have gone. We have done exceedingly well in terms of ROEC in advanced material as well as the sales of 1,000 crore rupees. At what capacity this advanced material division is running, sir?
So, see, the advanced material division is a combination of various businesses. The short answer to your question is we still have headroom to grow. And we are making fresh investment we made in FY22 as well as we are planning to make further in FY23. We will have headroom to grow as, we guided 20% growth, which we are looking to get. This will continue. We have sufficient headroom.
Okay. Thank you. Thanks a lot, sir. That's all my side, from my side.
Thank you. The next question is from the line of Prerna Jhunjhunwala from Elara Capital. Please go ahead.
Thank you for the opportunity. I don't know if I've missed this, but wanted to understand this accelerated depreciation of 7 crores that you've provided for. Is it one time? And if yes, then our overall depreciation on a quarterly basis also reduced. So just wanted to understand some clarity on how we should see depreciation.
Right. So this 7 crore is indeed one time. It relates to an overseas subsidiary. The depreciation by design should come down because we are on a straight line method. Of course, depending on how aggressively we are investing in CAPEX, and as we guided, we want to be watchful when it comes to CAPEX at least for next 4 quarters. So depreciation should hold at that level, excluding that 7 crore adjustment. should actually start to, inch down a little bit in coming quarters.
Okay. And second thing on interest, is it the actual interest cost or there are any adjustment in this interest cost as well?
So the interest cost which we report largely is actual interest. It also includes cost of discounting. The number which you see, 40 crores for quarter 4 and 51 crores for last year quarter 4, I mean, this decline is real. It's also reflected in our total debt profile. And this level we should be able to hold unless interest rate go up significantly. But we expect this trajectory to continue.
Sure. Thank you so much for the opportunity and all the best.
Thank you. The next question is on the line of Vikas Sharda from NT Asset. Please go ahead.
Yeah, hi, good evening. 2 points. One is, what is the outlook for the other segment for FY23? And secondly, there were questions on the project expenses. So it will be nice if you could segregate the financials of real estate, both in P&L and balance sheet, for better understanding of the other businesses.
Right. So we can do that. And others, as it has been guided in past quarters, should start to go towards neutral. The negative impact in coming quarters should start to come down, and we are pretty much on track with that.
All right. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Sameer Agarwal for his closing comments.
All right. Thank you everyone for joining us today. We'll see you again in 1 quarter. Have a good evening. Bye now.
Bye. Thank you.
Thank you. Ladies and gentlemen, on behalf of Arvind Limited, that concludes this conference call. We thank you for joining us and you may now disconnect your lines. Thank you.